Good afternoon. Thanks for joining us today for our market update. We're going to go ahead and get started in just a few moments.
Well, good afternoon, everyone. Hope all had a healthy and safe Independence Day weekend. So happy to have you all join Cliff and I today for our market update call. First, as always, which at this point probably doesn't need any introduction, I want to thank Cliff and introduce Cliff Hodge, our Chief Investment Officer. Welcome, Cliff, and welcome back from your family vacation.
Thanks, Jeff. It's great to be back in the saddle.
Well, let's get started and jump right into to the presentation. We're now halfway through 2020. As we all know, what a year it's been. We started January and February with basically hitting all-time highs in the market. We know that all came to a quick, abrupt halt in March. I don't know if anybody realized, but on March 13th, which happened to be Friday the 13th, President Trump declared a national emergency as a result of COVID-19 and shut down the U.S. economy as we knew it at that time. Following that, we basically went into one of the swiftest and quickest bear markets, markets dropping over a period of time about 35%. And with that, one of the quickest event-driven recessions taking place. We saw retail sales drop about 22%. We have seen unemployment applications at about 47.2 million over a 4-week period of time. The Federal Reserve, led by Jerome Powell, launched 8 lending facilities with over $2 trillion of loans that were made available. The Fed basically is holding nothing back. That led to the passing of the CARES Act, which was signed into law on March 27th of 2020, where an additional $2.3 trillion package was brought out. And unfortunately, in recent weeks, we've seen protests around the country in almost every major city. We've seen the relations with China and trade remain tumultuous, basically to say the least. With all that is going on and continues to go on in these unprecedented times, did any of us expect the NASDAQ to be back at all-time highs at the end of the halfway point? The S&P and the Dow off around 3%. Could we imagine that? And given everything that was going on, just the craziness. We're now entering the Q2 or quarterly earnings season of Q2, where next week the data, signs, signals, and expectations are never going to be more important than we're watching them right now. Just a reminder to everyone, there is a rule to investing, and there are rules we need to follow. Get invested is number 1, staying invested number 2, and 3 is diversifying. Getting invested doesn't mean what you're invested in, again, with the diversification in various vehicles. Staying invested, I know during that period of time, we've had a few phone calls saying, do I get out? Do I stay in? What do I do? Again, it's changing. We changed up the portfolio given the signs and the signals, as you've heard us talk over the past few weeks. Cliff, let's start jumping into the slides you prepared today. Review the markets and what you've been watching.
All right, Jeff, and just want to make sure you can see my screen here. Got the
thumbs up. We're good.
All right, good deal. Well, let's jump right in. We'll start with a review of performance in various markets. So I've called out 2Q over here on the far right, and as we'll see, very strong returns, very broad participation. It's interesting. I didn't include it on the slide today, but first quarter was down 20. Second quarter is up 20 for 2020, and now we're almost back to within striking distance of all-time highs on the S&P. NASDAQ broke back to all-time highs and set a new record high today, as we've had a bit of a reversal from yesterday's minor sell-off. But couple of highlights I'll call out. Year to date, the S&P is only down about a 1.5 compared to the developed international down 9 and emerging markets down 3. I'll highlight emerging markets here because they've actually over the past 3 months taken on quite a leadership position, which corresponds with some of the other signals that we track and that we point to. Mainly the breakdown in the US dollar has been extremely helpful for emerging markets. And so that's an area where we've got some exposure now, and we'll look to continue to add to that over the coming weeks. I'll also highlight just the wide sector dispersion that we're seeing in the markets. And so, as we'll see, technology, communications, and discretionary, i.e. Microsoft, Apple, Google, Netflix, and Amazon have all are hitting new highs. I believe the FANG stocks all hit new highs today. And then you contrast that at the other end of the spectrum with energy. Even though it had a great 2Q, still down nearly 40% year to date. Financials down 25, industrials down 15. A lot of the the more cyclical sectors, again, just highlights and reinforces our investment process. By and large, we've been able to avoid a lot of these areas, and just shows another reason as to why we do what we do here every single day on behalf of our clients. Same story from a factor perspective. So it's been growth and momentum are the only factors that are positive year to date, whereas value stocks, which are a lot of the banks, a lot of energy are value stocks, and then high yielding sectors of the market as well, all down still over 20% year to date. So quite the dispersion within the markets. But just from an S&P 500 level, it's nice to zoom out a bit and get a better view of where we've been and where we're likely to head next. As Jeff alluded to, we came into the year at all-time highs, had a really strong sell-off exacerbated by the economic shutdown from the coronavirus, but have since rallied back nearly 40% off the lows on reopening and a lot of optimism and stimulus, both from the Federal Reserve and from the fiscal. But as we looked, and I think, Jeff, you guys may have talked about this on the call last week, we actually broke down the returns of the S&P from the second quarter. What happened during the day session, so when the markets actually opened, 9:30 to 4 p.m. Eastern time, the market was actually down 3% for the quarter, which is quite unusual given that over 100% of the returns for the S&P during the quarter came when the market was actually closed. So just think about that for a moment. That's it's very highly unusual and certainly not a sign of a quote unquote normally functioning market. So we're going to continue to watch that, but it's something that we wanted to call out. Has led to again quite a bit of optimism and exuberance in valuations. So this is the forward price to earnings multiple on the S&P 500. So we look at earnings over the next 12 months. It's a combination of second half of 2020, first half of 2021. While we're down a little bit from where we peaked out at 23, we're at 22 and a half, still looking at NASDAQ tech bubble type of valuations. But in reality, when you look at the earnings perspective, it's probably actually a bit higher. The reason for that is because the 22 times PE of next 12 months we think is on an inflated E number, and that we highlight here in what are the consensus expectations for earnings per share growth for the S&P, down 22% for full year 20. But then ramping back up over and above where we were in 2019, fully loaded, coming off of the peak employment cycle, peak margins, peak deregulation, so on and so forth. We think that these earnings estimates are going to come down quite a bit. If history is any indication, what we've seen is that when we look back at post-World War II recessions, the amount of time that it takes on average for earnings per share to eclipse a prior pre-recession peak was 3 years. So, you never say never, but the probability, which is again how we like to view the markets and think about investing, the probability of us eclipsing the December 19 highs next year, I think, are extremely low, to put it mildly. So, as we continue through, we talked about a lot of the concentration in the market, 5 stocks, FANG, whatever you want to call them now, Microsoft, Apple, Amazon, Google, Alphabet, and Facebook now make up almost a quarter of the market cap of the S&P 500. So it's really these 5 or 6 stocks, if you want to throw in NVIDIA and maybe 1 or 2 others, that have made up the entire brunt of this move. We're even more concentrated in 5 stocks than we were at the dot-com peak back in 2000. So a lot of similarities between those 2 cycles continue to play out. From a sentiment perspective, and this is kind of another way to measure the optimism in the markets rather than just the PE multiple. This is the put-call ratio for listed equities. So the amount of puts purchased, which are kind of a bearish expression, divided by the amount of calls, which are bullish leveraged expression. On average, it comes in at about a 0.7. We're back down to a 0.45. So lower than we were back at the beginning of the year when markets peaked out, but not quite as extreme as where we were before the June, a little bit of that June sell-off. So still, very elevated, and this is certainly flashing kind of a flashing red caution sign when you look at both the valuation, you look at sentiment in the options market, and then we look at the large speculative asset managers, hedge funds, who are required to report their positions in futures and index options. This is measured for the S&P 500. These guys have been extremely net short throughout the duration of this rally. And we can see that they finally have, over the last couple of weeks, have capitulated. So that now this position, which was a tailwind for sell-offs, when you had a sell-off, these big players would come in and buy the market. It's now neutral, really at best. And this is from a Z-score perspective. We were down at nearly 2.5 Z-scores, and we're back up to 0 on a 1-year basis and -1 on a 3-year. So that's a pretty broad update of the markets, both where we've been from a return perspective, valuation, and sentiment. And so, Jeff, I will turn it back here to you for some thoughts before we move on to the economy.
Yeah, thanks, Cliff. I mean, those slides on the markets, again, and we did when Craig and Sean and I were on the call 2 weeks ago. We were talking about the after-hours trading versus the actual trading during the day. So I'm glad you put that chart up there. That was. I'm glad we were able to find that. And then I guess we got to figure out if it's not about the FANGs anymore, but MAF doesn't. Is it Microsoft, Apple, Amazon, Alphabet, and Facebook? MAF doesn't sound as cool as FANG. So we got to. I think you said something about FANG Man, but we'll have to see what those new positions are that are leading this market. Yeah,
we'll have to work on the acronym. MAF is definitely not as cool.
And Phil and Michael, thanks for the reminder. If there's questions that you have during the presentation, certainly go to the Q&A bar button, put them in there. So I know we've got a couple questions coming up here. So Cliff, let's kind of go from the markets to the economy and what we're continuing to watch from the economics and the economic data.
Yeah, absolutely. And so there's a mix of both positive and negative indicators when we look at the broader economy. As we think about kind of where we were just a couple of months ago with a shutdown, you're essentially at 0 economic activity in March, April, and then things have certainly improved sequentially May and June, and now we're getting to the point where, as we'll see some of the fiscal support will start rolling off. And there are quite a few risks that we're going to have to navigate in the second half of 2020. The chief among those being an election coming up, which will be heating up here shortly. But when we look at the weekly economic index of the New York Fed, I think the last time that we were all together, that index was down around negative 11.5 or so. We've improved to now down -7. So sequentially some improvement as things are opening back up gradually. One of the really good data points that we saw, I believe last week, was the PMIs, both the manufacturing PMI in the blue and then the services PMI in the green. Again, the way to read these charts is that anything north of 50 indicates acceleration over the prior month. Anything below 50 indicates deceleration or contraction. June is the first month that we've seen positive expansion since the beginning of the year, which is certainly a great sign. But again, it's coming off that extremely low base. There are businesses accelerating off of 50 to 65% capacity, not accelerating from a higher base. So we don't want to read too much into this, but certainly indicates what the markets have been pricing in since we've bounced off the bottom. The headline unemployment rate continues to track in the right direction as well. So down to about 11% unemployment from 15 is about where we were at the high. We're still above where we were in the 2008 global financial crisis. But as we'll see, while this number is positive, moving in the right direction, as we'll see, the situation on the ground is maybe not quite as rosy as the headline numbers would indicate. So when we expand the definition of unemployed, this gives us a little bit more of a fair picture as to what's happening on the ground, right? So you've got the 11.1 is the reported number. You've got this gray bar, which is that classification adjustment, which we talked about last time. There was an additional 2 million people in May who were, or actually maybe even 3, who were, misreported as employed when they really weren't. And then you expand that out to those who want a job but are quote unquote not looking. And then folks in the yellow here who are working part-time but would rather be working full-time but are unable to do so for economic reasons. So really, the amount of people getting government assistance is closer to 22% rather than the 11. So we're careful about reading too much into the headline numbers. Initial jobless claims. Again, this is when you file the first time after you unfortunately lose your job. About 15 weeks into the shutdown, we still saw an additional 1.4 million people file claims for the first time. So that now over 15 weeks, we've had almost 50 million people file for unemployment, which is just a very large and significant number that, again, we think is going to take potentially years plus to get back to the low levels of employment. Again, this is also a case where the headline numbers are trending in the right direction, but you can kind of see leveling off here in the dark blue. But when you also account for the PUA, which is the Pandemic Unemployment Assistance as part of the CARES Act, this applies to folks who generally otherwise would not qualify for traditional unemployment, like contractors, for example. There's probably another 1 to 1.5 million folks who are claiming PUA during the most recent week. So that it's really about 2.5 million people or so who are getting government assistance. As we continue to kind of move through the reopening phase. So a bit sticky. The other I guess cautionary sign that we look at when we looked at the jobless numbers and the claims is that the mix of temporary versus permanent layoffs is trending in the wrong direction. So the light green bar, these are the totals. The light green are temporary, the dark green are permanent. We can see the dark green box getting bigger each month. So that's that's certainly not a good sign. It is actually trending. The permanent amount is trending at a higher pace than we did back in 2008 or 2001. So we will continue to monitor the amount of permanent job loss, because obviously that's most important and will have much longer lasting ramifications for the economy. The other bit that we've seen is that the hardest hit areas of the job market are the ones that are bouncing back the quickest. So, obviously leisure and hospitality got hit the worst and has bounced back the best in the aftermath. Also, retail is another area where we've seen job growth, but and those are typically not the highest paying jobs, but certainly good to see that those folks are getting back to work. Also could be at risk if there are other shutdowns in this spike that we're seeing in this second wave. Good news, education and health services have seen a bit of a spike here as well, so that's certainly a positive sign. We talked about the optimism, potentially irrational optimism in the equity markets, and we could be seeing similar signs in the job market. So we look at folks who have, the black line is the workers, part of the consumer confidence. People are confident that they're going to be getting their jobs back in 6 months. And then you contrast that against those who are actually making the hiring decisions. This comes from the NFIB Small Business Survey. And clearly we can see that folks are not really seeing eye to eye. The workers who have lost their jobs are optimistic they're going to get them back. But the people who are actually making the decisions are not cranking up the hiring lever at this point. We'll continue to watch this relationship, but if our thesis plays out and we are transitioning from the shutdown depressionary scenario to a more normal recessionary scenario over the coming quarters, this confidence number will likely trend lower. We talked about the stimulus, both monetary and fiscal stimulus that has helped keep the economy afloat during the shutdown. And as we'll see, this slide is a timeline of how those benefits will begin to roll off in the second half of the year. So you got credit card forbearance ended in June, autos as well. State budget cuts start kicking in. You got tax filing in a couple of weeks, and so on and so forth. On down the line. So again, just want to be cognizant of the risks that we're going to be facing 2H second half 2020. And there's it's not to say that there won't be an additional package of some kind. There likely will be, but the closer that we get to election season, I think the harder it's going to be for the Republicans and Democrats to agree on what that bill looks like and ultimately how large it could be. So last but not least, before I turn it back over to Jeff, we mentioned risks that we're looking at. A second wave is certainly one that is beginning to become a bit more a bit can't think of the word I'm looking for, but poignant, I guess you would say. We've seen the cases spike here in the United States. A lot of that is a function of new testing. So you would expect to see some of the cases shoot up, but now we'll want to see those start to trend back down. But contrasting that with a bit of good news, the death rate has not tracked to the same degree as we're seeing with the new cases. So a bit of a mixed bag when it comes to the virus. Cases trending higher, but deaths trending lower and kind of petering out here is certainly welcome news. So we covered a lot of ground there, Jeff, but I'll turn it back to you.
Yes, thanks, Cliff. I mean, yeah, there was a lot of information there. Again, when you look at, there's some positive signs, some overly optimistic signs probably, and then there's, when you look at the virus, we know there is not a vaccine. So the ultimate would be the vaccine being found, being developed and distributed, but we're not there. But we're also seeing, as Cliff, you mentioned, with the mortality and the death rates kind of trending on a more positive note, is the therapies are working, right? So we have some more from the initial phase of the virus in a different mode, where we have some therapies that we're able to employ to help people get through the virus. But a big reminder, we're not over the virus yet. We have to remember that. So Cliff, let's move on to the indicators, signs, and the signals and positioning of the portfolios for our clients right now.
Yeah, I'll try to keep it brief here, Jeff. So I believe last time you guys maybe talked a little bit about some of the positioning. Our view is that we are coming out of what we refer to as a quad 4 environment, where both growth and inflation are slowing simultaneously, to what we refer to as quad 3, which is where growth is slowing, but inflation begins to stabilize and accelerate. So we'll talk a little bit about the implications for that, but do want to hit on some of the other macro signals that we monitor. First being the 10-year Treasury. This is showing here that bonds still are not participating in the equity market rally. So they're not certainly not buying it to the same degree that equities have been. Similar story with high yield spreads. While the risk has come in quite a bit from where we peaked out at over 1,100 basis points, we've had trouble kind of cracking this 600 basis point threshold over and above yields from the high yield market relative to yields on treasuries. So it just indicates a bit of risk still within the credit markets. The U.S. dollar. This is a big one that we've talked about and really will send ripples throughout the global economy and the global financial markets, because the dollar is the world's reserve currency. And we broke down really into May and June had quite a bit of a breakdown, and then we got a bit of a bounce here, but stabilizing and looking like we want to go lower. That's really positive for markets outside of the U.S., specifically emerging markets. Also very positive for metals, so gold, silver, precious metals, copper, base metals, you name it. This is all positive for that kind of inflationary sort of story. We're seeing that in broad-based with commodities. They've kind of broken through this resistance point and are forming what we think is going to be a nascent bull market that has plenty of room to run. So we've already gotten involved a bit here, and we'll continue to do so. Look for opportunities. Crude oil, we're seeing that here as well. Back up near about $41 a barrel, and again trying to punch through this resistance point that we put in back during the crash earlier in the year. Copper as well looks really strong. Has pretty much just been on an uninterrupted uptrend since the bottom, and so we'll continue to look at ways to play this theme across the book, but we do think we can likely get a little bit better of a price. When you think about the flashing lights and the warning signals, this is certainly one. This is the VIX, so this is the volatility index of the S&P 500. We can't get down below this 26 area, right? So a more normal volatility regime looks like this, in that the mid-teens, low teens range. Even getting down to 11 or 12. The fact that we can't get back below this line is certainly something that we're going to monitor quite closely, because even though markets have rallied, the volatility index is telling us that it's not going to take much to get more these more violent sell-offs, kind of like what we saw last month when we peaked out and then sold down sharply and then rallied back. So we would anticipate more activity like that as we continue to traverse toward the election. We've got a lot of risks that we've already mentioned, but last but not least, the 5-year inflation swap. This is essentially what this value gives you is the market's expectation for inflation on average, over the next 5 years. And as you can see, this index went from essentially zero earlier in the year to now about 1.5 or 155 as of maybe a day or so ago, as of July 7th. So this corroborates, what we're seeing with our quad theme, and as we, it's a good point to emphasize here when we look at quad 3, things that do well, commodities from an asset class perspective. So we've added a bit here, and we'll look to do more. From an equity sector perspective, it's that that barbell that we talked about, Jeff. Technology. From a growth standpoint, paired with utilities and real estate, a bit more defense in the portfolio. Real estate's an area that we want to be highly selective. We're not interested in shopping malls and office space and things like that, just because of the structural shifts in the economy driven from the virus. We're going to continue to avoid areas like financials, which we've seen have been one of the worst performers for the market. Consumer staples shifts from a long in quad 4 to an underweight in quad 3. So we've already made those pivots as well. Couple of factors. So growth, high quality, not really much exposure in small caps. From a fixed income perspective, tips we've added, investment grade credit we've added as well. And completely out of BDCs, convertibles, things that are a bit more high beta on the fixed income side. So that's a recap of the signals and positioning. I would say that all in all, net the market has run quite a bit. We have had some volatility, and we continue to expect that the volatility will remain with us, at least through the end of the year, or through the election, if not further, depending on the way that everything shakes out. So we will keep doing what we do here. We'll follow our process. We'll follow our signals and the data, and we will just continue to keep grinding away for you. So thank you.
Yeah, thanks, Cliff. I mean, again, in terms of, we got a couple questions, but as you were going through the positioning, again, we've got that barbell approach. So if you think when you look at that quad 3, you have some technology which is growth oriented and overweight towards that technology area, and then on the other side we may have some more utilities, a little bit of consumer staples. So we've got that barbell approach to be a little bit more defensive, commodities, all those things that Cliff just mentioned. And the same thing, it's high quality, not just our stocks, but just higher quality on our bonds. Again, a more defensive approach, because again, we're still in a situation that there's a lot of unknowns. Cliff has mentioned whether we have the election coming up is an unknown. We have where the virus and what's continuing with the virus, what happens. The still trade with China remains as an unknown, and what could happen. So there's still a lot behind everything that's going on that we continue to watch. So again, like Cliff said, our process being patient and following our process, and pushing the first part is being the planning. We've got a plan in place with our process and our patience that we're working along. So
3 Ps.
So that's right. The Ps are there. So we had a couple of questions, and some of it may have been answered, but one question from Phil, have expected poor second quarter, will poor second quarter results been priced into the current valuations, or do you expect a negative reaction as second quarter results come in?
Yeah, that's a great question. So by and large, the markets have given earnings a pass for 2020, right? So consensus expectations for second quarter earnings per share are down like 40%. So that piece is already priced in, but what's going to be very important is when these companies have to start giving guidance, right? So I believe it's somewhere in the neighborhood of 40% of S&P 500 companies have pulled guidance altogether. So now that they're going to have to start providing an update for third quarter potentially, and then end of the year and beyond. So guidance is going to be key, and our view is that likely the window of opportunity for volatility or a sell-off opens up here with earnings season, because our view is that again we're transitioning from an economic depression into a more run-of-the-mill recession, which is is certainly not positive for margins, for earnings, for growth, so on and so forth. So that's how I would think about earnings season.
And Cliff, I think you answered some of this, but any other thoughts is, Michael was asking, how is the market running so hot, though volatile in places, while the market is while the economy is severely affected, and our health is not anywhere near good as it yet, near as good as it should be yet. What is moving it?
Yeah, so optimism. You think back to the
Hope.
Hope. Yeah, exactly. That's that's part of it. Never underestimate the optimists. But then more importantly, I think all the stimulus, right? So when you look at the Federal Reserve's balance sheet, it's gone from roughly $3 trillion pre-virus to now $7 trillion in the matter of 3 months. So that's just an unprecedented amount of liquidity sloshing through the system that needs somewhere to go. Bonds, yields on treasury bonds are, as we saw, are extremely low, 65 basis points on a 10-year. So, stocks, you can still get a fairly decent dividend yield. On the S&P, it's roughly 2% compared to treasuries. So that's been a major part of it. Also, the fiscal stimulus. We've talked about the Robin Hood and the pajama traders that really took over the markets in March and April, and those guys have kind of pushed around the big institutions a bit, right? We saw the major institutional short positions start to roll off. So that that's really what's been driving it. But now the question is that that's all baked in, that's all known. Where do we go from here? So we do think there will be additional stimulus measures, both from the fiscal, from Congress, and ultimately from the Fed. But they're probably not going to be as keen, at least from the Fed perspective, to continue to print when we're at all-time highs in the NASDAQ and pushing 3,200 on the S&P. So we'll see how it plays out. But they're certainly going to want to leave some arrows in the quiver, so to say, as we go into the election season and volatility ticks up.
Thanks, Cliff. Over the past few months, you've continued to provide great detail on what we're seeing and what's the from the charts on what we're seeing on the markets, the economy, the signs and the signals as to why we are invested the way we are at this time. Protection of our client assets remains paramount right now. I read a quote the other day, and I think this was in you sent me an email, Cliff, but it was, "You can't always beat the markets," says standard doctrine, "but you can sidestep its worst punches." And I think that's what we've been trying to do regarding the pandemic, regarding the economic depression that we were in and are now recovering from, but it's not all clear yet, right? So we've just been ducking and diving some of the punches, the worst punches that were being handed out. Just a few reminders. Tax filing is due. It's approaching quickly. Typically, we all know April 15th. It's now July 15th. So next week, we will need to get our returns in. If you have not completed, or even if you have, a good time to ask yourself, your advisor, your tax professional, just a couple questions. One, can I contribute to an IRA or a Roth IRA? So if I did, great. If you didn't, why haven't you? Did I fully fund my HSA, which is a health savings account? Again, another tax deferred vehicle that you want to take full advantage of. And then did I include all deductions that are available to me if I'm itemizing? A lot of folks, again, with the tax law changes of 18, really were now just claiming standard deduction. But if you're still itemizing, make sure you're taking all those itemized deductions. Those are a lot of questions and a couple questions to finish your 2019 return. But it's also a great time to start talking and thinking about the 2020 tax planning. What can I be doing? So make sure you're talking with the Cornerstone team, your advisor. We can plan and map out the second half of 2020 for your taxes as well as your overall financial plan. Again, I want to thank you all for joining us today. We'll be back in a couple weeks and we'll continue with our series. If we can be of any assistance to you in any way, any family members, any friends, coworkers, just let us know. Stay healthy and safe, and please wear your mask. It's for everybody's care. Let's just take care of everybody. Thanks everybody for joining us, and we'll see you soon. Take care.